Hello everyone, this is Terry with Futures.io, and as always, I would like to thank you for joining us today. Now, it is my pleasure to welcome back Mario Randholm from RandBots for today's webinar, breaking down an equity trading system step by step. If you have questions, please feel free to type them into the questions box throughout the webinar, and we'll do our best to answer them at the end of the event. If you're watching us on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, you can follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I will hand it over to Mario, and you'll get the pop-up to share your screen again.
Yes, can you hear me?
Yes.
Can you see the screen?
Yes, we're seeing the front of the control side of the PowerPoint.
So we go full screen, swap this. We're ready.
Okay, looking good. She's all yours.
Great. So thank you so much to everyone to be able to join this webinar. Like Terry mentioned, we're going to break down an equity system. Before I start, I want to say that most of the trading information that I use is computer-generated information. So I feel very comfortable using math and statistics to be able to trade in the markets. I started trading in the year 99, and I became a professional in 2005. Since then, I have made and I have lost millions of dollars. So I think I have a feeling I know what I'm doing. I got an MBA from IE Business School in Madrid, and I did my bachelor's in Adelphi University, which is in New York. Like Terry mentioned, we're going to go through basic steps that I use to determine filters to trade equities in the US. Especially, we're going to focus on S&P 500 equities. We're going to review the rules. We're going to view rules for bulls that I use and rule for bears. We're going to talk a little bit about expected growth and the importance of that G for equity valuation. We're going to review an example with volume, another with price delta. And then to conclude, we're going to review, I'm going to give you an example of a very basic trading system that uses what I call the power of moving averages, which is a theorem of large numbers. Okay, but before we start, a healthy point to start is the first thing I do is when I start building a system is define the account size. You cannot build a system or a trading system if you have the same way, if you have $1,000 or if you have $10,000, $100,000 or $1 million. Okay, and then the second thing, once you define the asset under management of that system, you have to define a position stop loss. You want to lose a lot quite often on that system, or you want to take small losses, but quite frequently, right? And the other thing that you have, or I feel very comfortable setting, is a max system loss. So this is the maximum drawdown I would allow this system to take before I hit the panic button or I stop trading the system automatically. Right? My profession is I help to manage capital for corporations and families, and I offer them strategies that create diversification for their investments. So we're going to go down into what I call is the trading basic of this system, which is an equity trading system focus on the XPX, and this system uses about 1.5 leverage. Okay, The first step is we're going to analyze what I consider quality equities. And the second step is to focus on growing equities. For that, we will use equity, the earning per share ratio, which is quite famous for equities, and I'll review data from 6 months to 12-month data. I will use step 2 after I get the first filter in what I call quality equities. It's important to understand that if you follow a system, you are taking the risk of that developer, right? So what I tell my clients is my systems match my personality. So I know what to expect when things go well and when things don't go so well. If someone follows blindly a system, is taking the developer risk, and sometimes the developer's risk or psychology do not match the client risk. And this is very important to know when you start trading someone else's system. Okay. The system look for mega stocks, what I call mega stocks, what I call in sector A, right? This is step 1. And then it looks for what I call in sector V suppliers of these mega stocks, right? To give an example, it would be Apple, it would be a mega stock, and a supplier would be the company that makes the camera, or the company that makes the screen, and so on. And then I look for a sector C in the system, which is ETFs that represent the performance of these companies, because I want to find laggers and leaders versus those ETFs. Right? Then I leverage the system, which is I call a correlation. And then from time to time, the system use options to mitigate the risk on some of these companies, right? So here you can see the importance of this break of these 5 categories. So for example, in leaders and laggers, I look at sector A, B, and C equally, and I barely focus on correlation or decorrelation options. Right? However, here when I look for volumes, right, price high and low volume, or vice versa, low price and high volumes, the correlation factor is important, because I use options to hedge. For me, what makes all the difference is the risk system. So this is important that you understand what can happen to avoid a catastrophic loss, right? And you have to define what catastrophic loss means for you. It could be something that you can recover in 3 months, something that you could expect to recover in 6 months, or something that you could expect to recover in a year. For this system, a catastrophic loss would be something that can be recovered in 2 quarters, so in 6 months, right? Also, based on experience, I have found that it is very hard, actually impossible, to win big without having the experience of failing first. Okay, that experience of being down and struggling with the system, it's what makes the trader character that will be needed to be successful in the business. Let me give you an example of a portfolio with $1 million, right? So the client says this: I have $1 million to invest, and he wants a concentrated portfolio based on this system with about 12 stocks. I asked the client, what is the risk you're willing to take, and in percentage? And the answer was quite simple, 8%. So I know that the catastrophic loss this client, hypothetical client, can expect is $80,000 over their capital. Okay, so then by an equation that I will share with you in Excel later, I define the risk. So I know that I can take about $2,500 risk in every single stock that I will trade. That's about 12 stocks, right? I'll show you this in Excel later. And then I have a dynamic stop loss based on the volatility or ATR on the strategy. I'll show you this later in Excel. So here with this Excel, for example, we went in. This is all tech, Amazon, Facebook, and Nvidia, and these are the position size in dollars, and this is the amount of shares needed, right? To review the importance of G model, right, of Gordon growth model, which is used, you can find this on Wikipedia, which is used here, you can say, estimating the fair value of an equity from a given or assumed cost of equity. Okay, so different players around the market have different growth values. We can expect Apple to grow at 10% a year, and another company or another asset manager can expect Apple to grow at 12% a year. So that little 2% difference between our view and the third-party manager will shift the expected price of Apple quite heavily in the future. And it's very important to understand the estimate of what the market gives to this growth. Okay, and I'll show you a few examples, like with volume delta, with the SEC filings, and with new product sales. And this is what drives, into my opinion, right, growth, expected growth, right? This is how I detect if other players are seeing different growth that I do in certain equities. And like Warren Buffett said, right, the investor of today does not profit from yesterday's growth. The way I translate that is, to be able to make money in the market, you have to place a bet, long or short. But the market, sooner or later, have to agree with you. That way, you can collect your profits, or the market will force you to take the loss. You know, the investor of today cannot profit from yesterday's growth. You need to read what the market growth is going to be. That way, you can profit from your bets. Right? Here is an example. This is Nvidia, and here we are reviewing the earnings in the Q1 of 2016. This is when the stock popped into the radar of the systems. Like I mentioned before, we are looking at earnings, right? So at 9:15, this is a system, Thomson Reuters system, 9:15 a.m., Nvidia rises because of earnings, solid earnings. At 10:31, another majorly read news, beat earnings, right? And at 10:40, Nvidia hits the 52-week high. This is when I read the system. I got the trigger, okay, new high Nvidia because good earnings. And this is back in Q2 2016. It's here. See, I don't show the chart here because the trigger of the system did not happen until a year later. So that this is Q2 2016. The system went long once the delta, the volume delta, had a major spike here. The volume was decreasing here, and then reported earnings. This is the volume delta or volume difference, I think the indicator is called. The spike, and the system realized, okay, large players, very large players on the market are buying these, and it is a big likelihood, right? I have this with numbers. There is like a 90% likelihood that this stock will not retrace. So this is important. I recap. The trigger was in May 2016 for the system to analyze the stock. The entering on the position was in May 2017, a year later, but with a very high chance probability that these earnings confirm the earnings of a year before, and the stock is ready to run. Okay. Another one of the filters I use to measure what the market expects for growth is forward enterprise value, right, divided by revenue. This uh, greenish line, continuous line here, right? And I will explain this little chart how it works. This is the trade on the NVIDIA. So in 2015 here, this was the trigger, right? It started following the stock, and I follow the price, which is below what the other analysts are looking at. Let's see, 1 second. So I see that what the market expect is this price is expected value above the current price. So the stock remains in my focus, right? Until the volume triggers the entry. And this is right after earnings. This is my courses where I execute it, right? And then I follow what the market is expecting to do with enterprise value. So they report earnings, the analyst 2 weeks or 3 weeks later, they modify the expected revenue and the enterprise value and goes higher. So in these earnings, I just have to watch, okay. In these earnings, I have to watch the still going higher. Then analysts correct, right, the price, the stock retrace, and this at this earning, what the market expects from the equity is below what the equity itself is doing. So I exit the trade here. So there is 2 triggers here. The trigger to enter with the price, the delta variance in volume, with a filter of enterprise value divided by revenue, this line here. Then every earnings, or every single day, you check that this price does not cross the stock price. But especially on earnings, because it moved considerably, you check there is not a drop like this. And when this drop happens, the system simply exit out the trade. Of course, the trigger was 2015. We entered in 2016, and the trade lasted until Q2 of 2018, right? 18. So this is in a year, the stock went from 100 to about 200, right? This is one of the ways I measure the expected growth of the market. The other one is SEC F13 filings. And what do I do? What do I look here? So I look for very strong opinionated managers. And I call this high reward, high risk trades. Yes, the SEC F13 filings come with a delay. Yes. But for example, let me show you a trade that was picked up because of Berkshire footprints. Berkshire is the company managed by Warren Buffett. As you can see in this little screen, in Q1 2016, bought for the first time Apple, right? And Berkshire bought about 15 million shares of Apple. So here my question was, is this really a trade of Warren Buffett? Or is one of the managers working for him that wanted some exposure to Apple? So I didn't know. Right? Then the next quarter comes and he increased the position 55%. So he goes from 9 million shares, sorry, to 15 million shares. And then in Q4 2016, he goes 275% X, right? He doubles the position. He goes from having 15 million shares to 57 million. So this is something that is a very strong opinionated managers. And historically, when this manager start opening this type of positions, that not close with a retracement on the stock. I mean, the average holding period is measured in decades, not decades, but it's measured in multi-year periods for Warren Buffett. So here, after this, it became a trigger for me to follow the stock on the system. This is 2016 Q4. Okay, and this is a tool that shows which type of entity is purchasing the stocks on the F13 filings. So here you can, or I can filter between hedge funds or momentum or short-term trading, etc., etc. Right? So it was picked up. The trade worked as follow. It didn't work very well for me, but it's working very well for Berkshire. Like I mentioned, the trigger was here, Q4 2016. So we have Q4 2016, right? The stock didn't perform very well. Earnings gap up, enterprise value divided by revenue expected above the current price, gap up. So this is a quite significant chance that Apple will continue trading higher. It went higher, it went higher, went higher. At this earning, we monitor, right? We monitor that the enterprise value did not correct, and it did not correct a lot, right, to cross the price. And then here, this earning in August, Q3, the enterprise value went down. We closed the trade. We probably did we know that we did the wrong thing now, because Apple moved from 120 to 222. That was yesterday, I think. Yesterday, I got this yesterday, right? So this is another example how I went through the SEC filings with an Apple increase of 200% X from Warren Buffett, right? And just to continue with this thesis, I still have my questions why the largest position of Warren Buffett is Apple at the moment. But for those that are interested on this, I could develop a little further. Right now, from the current market cap of Apple, 54% comes from the iPhones, right? And 17% comes from services. This used to be 10% a few years back, right? So there is a new services that Apple is selling, which is working very nice for them, is especially the iTunes, iCloud, and the Apple Pay, and so on. But there is something on Wikipedia which is open, which is called the Project Titan. So if you want to know, or if you want to make a thesis why I think Berkshire would take such a large position, so we can explore this here. So here is where we go into more details for how the system trades and how the system reviewed it. So here we have S&P 500 companies with a compounded earnings growth of 20%, right, for the last 3 years. These are companies that are making money consistently every single quarter for the last years, for the last 3 years. We're looking at earnings, and we have another filter for sales, right? And you can see how NVIDIA popped up here, and there is other examples, right? So this is the Excel itself that I can share with you. You can email me and I could send you this Excel if you want. We have the floating shares by institution here, and the name, the sector, and this is how I review which sector and if there are like mega cap and suppliers of those mega caps, right? Then we have a similar filter for diluted earning per shares, and here we filter from 25%, right, below 75% of earning per share growth in a 12-month data. I can send you this as well. And we have filters for selected sectors, especially looking for 3 months, 6 months, and 12 months. These are filters for the bulls. Let me review the Excels with you. So we download this and simply we go from companies that are doing very well to companies that they are not doing very well, which go into this one, for example, is doing very well in 3-year basis, to companies that are not doing very well in 3-year basis, just looking at the revenue here. Here is some of the examples that all the filter we showed in revenue, and then the filters I showed for earning per shares. Right? This is the top, I think it's filter by, yes, between 25 and 75%. I can, if you want this, I can send it to you. I have no issues. This is what I think is more important. This is when the clients say, you know, I have $1 million investment. I want to concentrate a portfolio of 12 stocks. I'm not willing to lose more than 80K. So this is 8%. So how the math is done is quite simple. So we know, I'll show you, 80% divided by $2,400 is 33. So we have 33 trades, right? If we lose in every single one, we'll reach about 80K. I can assure you that it's very hard for the system to lose in 33 trades in a row, right? But this is the worst case scenario you can expect. I was trading during September 11, so I know how bad things can get. You know. But for the system, it will be complex to lose 33 times in a row. This is why it's this filter here. The way I calculate, or the system calculates the stop loss, it's quite simple. We take the ATR in 14 days and the ATR average of 30 days of every single stock, updated every single night. When, let's say, the ATR in 14 days changes to the upside, you'll see what happened to the stop loss, right? If it goes low, you see the same thing here. If the average changes to 50 to 10, right, we increase here. So let me go back to this. So it's 40, and this is 30. This is 31. You can see 32 doesn't change. 38 doesn't change. 41. Let me see. 40 start changing because it's equal. 41, 45, and so on. So this will modify every single position here, right? And this is how the leverage becomes, right? So for more details into this, you can explore the Wikipedia articles about the turtle trading method, or this other article. It will explain in great details how this ATR works. So going back to the PPT, display swap. These are the Excels. We go forward. This is a filter that I use for the bulls. I understand that reviewing third-party data that you didn't compile is complex, but this is one of the most accurate data I can get on forward earning per shares. This is from IBIS. And for example, here is a bull on the tech sector in 2017 based on my interpretation. So 2017 is this is what the market expects on earning per shares, right? And what I look is mathematically, what I look is at the lower value here. So I have 14.1, 14.7, 14.2, and the next year we have 16.5. So it is an expectation of the earning per share growth of the next 12 months would be positive. So this gives a trigger on earning per shares in the tech sector, and I start adding tech sector exposure in those systems. Of course, it's important that the 16.3, 16.7, 17 is also continuing the trend, but the trigger is this lower number that increases, right? For me, the same thing now for 2018, the increase from 16.5 to 17.3 is an increase, but it's not as significant, which did not trigger a buy so aggressively in the tech sector, right? Here is an example for the bears. This chart comes from the New York Times, Wall Street Journal. This chart comes from the Wall Street Journal. This is publicly available. This is why I show you this. Yes, it comes with a certain delay, but it's important, it's still valuable. The same way I looked for earnings to be positive or sales to be positive, I looked for the negative compounded annual earnings in the last 3 quarters. This is for negative. And most of the times, these stocks are normally the biggest short positions in the stock market. Sorry, give me 1 second. So here you can see the average daily volume, the change on the day, right? Well, the change on percentage, I will have to double check. Infosys 97%, but it gives you a clear idea where are the most shorter stocks, and you look for the weaker in the weakest sector, the same way that we look for the positive in the stronger sector. Here is the example for the bears in the financial sector in 2016. Okay, the same thing that before, forward earning per shares with 12-month range. This is the 16, this is the 15, and this is the 14. The 14 and the 15 matches with 12.6, and the following year, the market expected lower forward earnings for the financial sector. This was a sell signal for me. It did not work very well because 2016 was not a very weak year for the market, but banks did not perform as well as other sectors. Then the following year, 17 performed, and now this forward earning for this year is lower. This will update for next year, which I expect that with interest rates, this will go, I expect, higher than 13.1, right? And this will force the system to start taking positions on the financial sector. And we're getting close to the end part of the webinar, and with time, we're doing okay. And this is the filter I use. What I call is the power of the averages, the power of the moving averages. And this is the theory that also you can find in Wikipedia, a brief description that is called law of large numbers. Let me try to explain it here with this little chart here. So we have three different buckets. The first bucket, you see a point, like, which is a particle. This is normally used for molecules, but it can be used for stocks. You can see that the particle, the first particle, seems to move randomly. It seems to move randomly, right? After the loop starts. Then you have a number. Then we combine more particles, which also seem to move randomly, but they do not. You can see how the particles start from here and expand to the right, right? They start here and expand to the right. So we can see there is a concentration on the left side in the particle, and then little by little start moving to the right side with more particles. And when we add many more particles, we see a clear tendency that after a trigger, the particles start moving to the right side, starting filling this white space. With one observation, it's very hard to expect that the particles are moving to the right side. With a few observations, okay, we can see that. With thousands of observations, and there are thousands of stocks listed on the stock market, we can have a clear picture that the stocks in this, or the particles in this diagram, are moving to the right side. And let me detail for you this chart here. The chart here is the S&P 500 starting in 1998, right? I started trading in 1999, the summer of 1999. So from the beginning of the chart to this period, the system was long, right? One of the systems I'm going to very briefly explain, which is quite easily. It was long. From the opening of this candle, right, to the close of this candle, in 26 months, it made 39%, roughly, right? Not considering trading costs, taxes, and so on, roughly. The price movement from this point to this point is 39%. Then the system went into cash, 100% cash, for 31 months. This is a long time. For a wealth manager, it's a long time to be in cash. The industry will not tolerate this, right? Think if you're a hedge fund manager and you go 31 months on vacation. But during that time, the stock market performance from this point to this point, right, from the close of this candle to the opening print of this candle was minus 26%, minus 25.6%. Then for 54 months, the system was invested, fully invested, with a return of 43% in price. Then the system went in cash for 19 months, were protected about 33%. Later, the system for 26 months straight was 32%, similar to this. Look, 26 months, 39 or 40, and then here in 32. Then for this little return, right, for this little 4 months, actually the market traded higher. We lost because we were not invested about 7.6%. Then for the following 73 months in the market, the price improvement was 50%. You get the picture, right? For the following 9 months, actually we lost because the market performed positively from the close of this bar to the opening of this bar, about 6%. And now, until the 19th, as you can see, the 19th close, the system is invested with a 39.8%. This is a very basic system made with moving averages. No optimization, nothing else. Just moving averages, and the drawback of this system is here you have 3 months straight losing until you exit, right? Here you have 3 months straight losing until you exit. Here you have 4 months straight losing, and the last month quite nasty month until you close or you go to cash. And here you have 1 month losing, a very negative month, until you go to cash. Here in February of this year, the system did not go to cash. So I repeat, if you want more information about this, I can happily share with you and email me, and I can send you the details of the moving averages used here. But it's quite basic, and for a long period of time, it has positive performance or positive expectancy, right? So this is what I meant with the law of large numbers. Once we have a stock which is hard to predict, if we have multiples, we see a tendency, and when we have thousands of prices, we very much mathematically we can get an idea of where things are going, right? Then I use other global checks on the systems, and this is what is called the policy uncertainty. Okay, so in the latest years we have Trump's, the Trump win the election. It was something not expected, and the futures overnight dropped 5% overnight, right? Nasdaq and I think S&P 500 were halted. Then we had the Brexit and the European refugee crisis. For more information on this, you don't have to get to Thomson Reuters. With policyuncertainty.com can help you. Of course, this is nice because you can have this updated and connected to the computers. But if you don't need to get this data because it's not cheap. Another sample that I use for cross check, right? Macro data is, for example, U.S. unemployment. Here we have data points of unemployment, right? Monthly change in payrolls from 2011 and 2014 is these periods, these points here, these dots. The 2008 started triggering an outside band that was not known before, right? And then the 2009 data, so we know what happened between 2008 and 2009, that the 2009 data so was quite negative. The important thing for the system was to review 2009 2010 data that is about here, some of them are here, and then the 2011 going back here with 2006 and 2004 data, something like that, and 2014 data here. So it looks for correlation, the performance of those years and unemployment. And going more into details, here, for example, we review the Spanish unemployment of Spain by region. So this goes, I mean, to do this manually will take a lot of time, and I don't know if you have that, but if you compute, for example, when Madrid increases unemployment versus the Canary Islands historically and the percentages, it can give you a nice expectation that the outcome of the Spanish economy, it might be different if the unemployment increases in the Canary Islands versus in Madrid, or if the unemployment increases in Madrid versus other regions in Spain. And this is cross-check data, macro data that they use for filters to understand if the catastrophic loss is close or not. But yeah, I understand this is great, right? I mean, if you like the presentation, and I appreciate if you could send questions. But what the RandBots that for you, and what RandBots that is a great thing, in my opinion. it allows you to profit from my work and from the work of those that work with me at a fraction of the cost, right? Let me show you an example. So this is an equity trading system that started in 2013. And these returns, they are hypothetical because I only consider real returns, those from your broker statements, okay? But these returns are including the fees and broker commissions. As of yesterday at 3 p.m., year to date, the system is at 32%. Right, this system traded more than 1,000 times, executed more than 2,000 trades, so enter in and out 1,000 times. The winning ratio is about 37%. So that means that the stop loss is very close. We are hitting the stop loss quite often, right? The system got to a max drawdown, the max pain that I mentioned before of about 30%. And you can expect, or the history says, that it has a 63% win month ratio, right? If you want, the system is available at RandBots, or email me and I can share more information. This is how the system works. Like I mentioned, like it has only 37% win rate, right? But when it win big versus the losses, right? And of course, I read here the disclaimer. Par performance is not indicative of future returns, right? The past, I can tell you, this is how I did. This is how the system performed. Tomorrow, October, November, December, I don't know. Okay, I don't know. If I knew, I wouldn't, I would put all my eggs in one basket. That's why there are multiple systems in RandBots. Okay, so let me give you a little details on this Excel. This is the trade P&L in US dollars of these 1,000 trades, right? So the max loss the system took was less than 10,000 K. The max gain, which is an outlier, it was above 70K, right? The second max gain was about 40, and then there are a few above 30, a few above 20, and multiple between 10,000 and $20,000, right? There is a big tail here, consistent, right? Consistently growing trades, right? And then there is about 60% of the trades losing trades, but the system keep a very close tight stop, right? This is available for you at RandBots, and if you have questions, just tell me. I can help you. The average win in this system is 2,766. The average loss is 950. The average duration of the trades is about 30 days. And because this unable, or the system is able to do this because of the risk management we explored in the Excel before, right? So with this, I conclude very much the presentation. Like I mentioned here, you have direct email to me, and or you can use Twitter if you prefer. And to conclude, I open it for questions, but I always say that most traders remain humble, and because we understand that one mistake can ruin a reputation that have taken years to build, And the other thing is that for those of you that are starting, is expect pain. I mean, and and that pain, take the best of that pain the first few years, because it is required to build your confidence and to build upon you, right? RandBots, I believe, that offer you systems that are proven and are traded by corporations and financial professionals, which can help you develop ideas, or it can help you to diversify your investments. So, and here I now open for questions. Terry, if you
Okay.
have any
If
comments.
you have any questions, please feel free to type them into the questions box, and I'll ask them to Mario. How do you find the stocks that are closest to the law of large numbers?
Okay, I mean, the thing is, I don't look for stocks for that are closer to the laws of large numbers. What I do is I use many stock prices to get the law of large number working, right? So let's say today, from the stock S&P 500 stocks, we have 250 stocks going up and 250 stocks going down, right? So we could say this is an average data, an average day, nothing major. But then we review the data in a few weeks, and we see that from the 500 stocks, 3 days in a row, we had 400 going up, 3 days in a row. So now we can start to read, or we can start to make the hypothesis that we could test that, okay, 1,500 stocks of 1,500 different prices within 3 days has been going up. There is something cooking, right, in the S&P 500. And then if you add the Nasdaq, you add the Russell, you add European data, you add Japanese data, you add Chinese stock market, you add Indian stock market, then the rules of large numbers start working. So then you have many stocks going up, right? And you can make a hypothesis based on history and statistics that, okay, there is something cooking. And then you can take a decision to go long or to go short. Mm-hmm.
Okay. Uh, I would give everyone another minute or so to put in the questions. Is there a to you what would be a minimum account size to trade equities?
Tricky question. I mean, I would, let's say, I would turn the question around, saying, for me to be trading, I would like to at least make $10,000 a year, right? To be able to make $10,000 a year trading, I would need to make at least in equities between 20 to 30% return. And that will give you a number that should be around 20 to 30,000 to have a diversified portfolio. I mean, you could go the other way around and say, I like this stock, I'm going to buy this stock, I'm going to hold it. I like this company, and you are an investor in equities, and you do not have a diversified portfolio. That you could go that way and put $3,000, $10,000 in a stock. But to be actively managing a portfolio with at least 10 underlines, I would consider minimum $1,000 per underline. That will make it 10,000 at least. And then you have to take into consideration the strategy based on frequency of trades and trading commissions and so on. But with 10,000, even if you make a 25% return with $10,000, I don't know if that's worth the time of the trader, right? Maybe good. I started with a very small account myself, right? I started with 5K in 1999. That account now grew bigger, but also many years had passed as well, you know. But yes, I started with a very small account during college. It's actually pre-college, and that's how I learned. You know, I I never actually simulated before going live because I didn't find the value. And now that when people simulate, they find it, they need, when they go live, they find it a different ball game, because it's a different ball game. You know, the feelings and that pain starts when you start trading real capital. Hmm.
Okay. I believe that's all the questions. Thank you for the webinar today, for the information, and for spending some time with us this evening.
Great. Thank you so much, Terry, for hosting the webinar.
Absolutely. Thank you.